afternoon, everyone, and welcome to another FundSmart webisode powered by First Metro Securities. My name is Cara from FirstMetroSec, and I, including the rest of the team, hope you find this webinar beneficial for whatever purpose it may serve. For this episode, we have teamed up with one of our FundSmart partners, Philequity Management or PAMI. For those new to our site, FundSmart is First Metro Securities' online mutual funds platform, which allows you to subscribe to over 40 peso and dollar-denominated mutual funds from the six leading fund houses in the country. One of them, of course, is PAMI. It is located on the upper right corner of your First Metro Securities trading platform. On FundSmart, you can also filter and sort out the various funds by its performance, risk profile, risk rating, fund type, currency, and the like for your convenience. Our speaker for this afternoon is Miguel Agarao, PEMI's Vice President, with his topic, Riding the Bull Market Through Equity Mutual Funds. When we speak of bull markets, we normally associate it with investing in equities. But today, we will be giving you another option to maximize your hard-earned money through mutual fund investing. Just a brief background on Miguel, he is the Vice President of Philequity Management and a current equities analyst at Wealth Securities Incorporated. He was a former market and liquidity risk officer at East West Banking Corporation and a former investment analyst at Emerging Markets Focused Research Corporation. He graduated cum laude from the University of the Philippines, Diliman, with a degree in Bachelor of Science in Business Administration. And before we hand over the mic to our speaker, we would like to take this moment to remind everyone that you can send in your questions at any time through the side panel provided if you're on your computers, or swipe left if you're watching this webinar through the app on your mobile phones. We will be answering them later in the Q&A portion of this webinar. You can also download the latest PAMI Fund fact sheets and the latest Philequity Corner articles through the handout section of the side panel to give you a better picture of our topic this afternoon. And again, PAMI funds are available to you online through FundSmart with no sales load. We also have exciting items for giveaway, so we hope you guys stick around till the very end of this webinar and be sure to join our growing Facebook community. If you're not yet a member, just type in www.facebook.com/groups/FirstMetroSec, or you can also search FirstMetroSec Official Community on Facebook. We would also like to invite you to like and follow the official Facebook page of PAMI to get their latest updates, or visit their website, www.philequity.net, for more information. And now, without further ado, our main guy for this Wednesday afternoon, PAMI's Vice President, Miguel Agarao. Miguel?
Okay, good afternoon, everyone. Thank you for finding the time to listen to this presentation. I know the Holy Week is about to start, we really appreciate that you found time despite your busy schedules to listen in. So before I take your vacation, I'm going to share some things that can help you guys invest in equities. Before we go there, though, I want to ask all of you, what do you think is the most important factor that determines portfolio return? So I won't really see your answers, just try to think about it. Now, some people would say it's stock picking, like picking what stock will do better than the rest of the market. Some say it's timing, buying when it's low, selling when it's high, rinse and repeat. Some say it's luck. I believe luck does play a factor, but for some people, they think luck is probably 99% of the result. Some people even believe in feng shui. Now, what research shows is that asset allocation is what determines bulk, nearly 100% of an investor's return. So many research studies have come up with this amount, and between 90 and 95%. So of all the factors out there, it's asset allocation that will determine how much money you're going to make. So when I say asset allocation, it's basically the mix of the different assets in your portfolio. And there are different types of investments, like cash, that counts as an investment, also a time deposit. So basically, you're leaving this in the bank. Other than your cash in Philippine pesos, some people opt to invest in the US dollar or other currencies like the euro, Japanese yen, that or they're using it to shop abroad. But if not, then it counts as an investment. Finally, fifth, you also have bonds. I think this was the topic last week. So the speaker then spoke about this extensively. Now, for the girls listening, jewelry also counts as an investment, as does gold. And more recently, a lot of people have also been investing in paintings. So some paintings have become very expensive already, especially if the artist is dead. Um, Other than those, the more typical investments would be, say, real estate. For those who have property in, say, Makati or Pasay and happen to be leasing it out to the POGOs, the Chinese online gaming, you can see that being invested in real estate in certain areas have become very profitable in the past 18 months or so. Or businesses are also a part of your investment. Some people have one, some people have many. But for today's presentation, what we'll be talking about are stocks and mutual funds. So, like I said earlier, if you look at all the different assets that I enumerated, the choice of which one comprises your portfolio or majority of it will over time determine how much money you're going to make. And that's going to matter more than um, buying a still life painting or a self-portrait or buying a consumer company versus a bank. What will matter more is how much you put in cash, bonds, real estate, a business, or even stocks. So before I go to the meat of the presentation, just for all our listeners out there, your asset allocation should be based on two primary factors: your risk tolerance and your time horizon. So some people, we've had this in one of our presentations, they're already losing sleep even though they don't have majority of their portfolio in stock. Some people really can't buy stocks, they'd rather hold on to hard cash. There are others who are the direct opposite. They want to take the highest yielding and usually the highest risk investments to get the biggest bang for buck on their money. So, but ideally, one should have a mix of different assets in their portfolio, not necessarily all stocks at the same time, not necessarily all cash. So given that, why should one invest in stocks? It's because research shows that over the long term, stocks beat the return of practically every other asset class. It beats bonds, it definitely beats cash. So I'm going to show you that later. But you guys can Google it. A lot of research has already pointed and proven this conclusion. What you see here now is a chart of the Philippine stock market over the past 10 years. And what you see, it has more than quadrupled over that time. So so you see here, we also, for the education of our viewers, we have a column that comes out in the Philippine Star every Monday. It's called Philequity Corner. And there we talk about our strategy. So it's out there for everyone to see in print. We also talk about current events regarding the stock market and other asset classes. Now, one of the particular articles we wrote about 10 years ago was on March 2009. We told our readers and our clients that we think this is a generational low for the stock market and that it is an opportunity of a lifetime for those who are going to buy stocks at that point. And we repeated that in the same month. And since then, if you look at it from the bottom, our stock market has quadrupled. You can see our articles in our online archive, so we talk about our strategy there. Now, despite the market quadrupling, you'll see there have been corrections. It wasn't a smooth ride, but that up 400+% return already includes all the corrections during this entire bull market. And you see there have been quite a number of them with large percentages. You'll see in 2010, there's a 15% correction, 2011, 19%, And 2013 until now, there have been 4 20+% corrections. For the traders there who are listening, when the market falls 20% or more, that counts as entering bear market territory, and yet our market still continued moving higher. So you see, corrections are part and parcel of a bull market. It does not make investing in stock something any less profitable. It makes it volatile. But you see, despite all these, the market is still up quadruple over the past 10 years. Now, if you take a longer term perspective, let's go back to 1987. Not only did you have sharp corrections, you also had bear markets in between. So these are very sharp drops in the market, 50, 60%. They take at least a year to play out. But you'll see, despite having bear markets, the market has gone up quite significantly. And there were also a number of crises then. For example, in 1989, you had bloody coups, Mount Pinatubo erupting, earthquake in Baguio. 97, you had the Asian financial crisis, which roiled the entire region. And thus after that, you just recovered a little bit. You had our own political crisis coupled with the Iraq War. We recovered for about 5 years, 6 years, and you had the 2007, 2008 financial crisis. And fortunately, since then, no major crisis yet. And in our articles, we called the bottom in those two occasions you see on the screen. You had Yolanda and QE tapering in 2013. But again, since 07, 08, you have not seen a bear market. But despite these 1, 2, 3, 4, 5 sharp drops, you see the Philippine stock market has still performed very well over the long term. So if you just hold on for a long period of time, and even better, if you buy on those dips, you'll find that stocks will outperform practically all financial assets. But just remember, as it's written on the slide, it has to be a diversified portfolio of stocks. Sometimes you can get lucky, you'll get the stock that outperforms, but you can also get unlucky and pick something that experiences a very significant negative event. So it's best to really have a diversified portfolio of stocks that you'll hold over a long period of time. And you will see this will outperform nearly every financial asset. So why buy stocks now? We get the question from both really young and really old clients on when is the time to invest. I haven't invested in stocks yet. We tell them the time to invest is now. Actually, it should be yesterday, but since you can't turn back time, it should be now. So I'll show you how the PSEI performed over the past year. You'll see there have been corrections, but after hitting bear market territory, our stock market recovered more than about 20% from the lows. In fact, at the start of the year, we were the best performing stock market in the world. So why did the Philippine stock market recover so sharply? If you recall last year, what was on the headline was high inflation. The price of sile and other vegetables went up a lot, and there were memes about that even on social media. Now, fortunately, this year, you saw that inflation has fallen quite significantly. It's back within the BSP's range of 2 to 4%. The BSP is expecting full year inflation to be 3.1%. The average for the first quarter is already below 4%, but the BSP really wants it to go maybe closer to 3%, which is the middle of its range. Second, the foreign selling of our stock market turned into buying. The reason this is relevant is because a little over 50% of trading volume in the Philippine stock market is done by foreign funds. In other words, if half your volume is selling, it will be very hard for stock prices to go up. But in the same token, if half of that volume is buying, or like in what you saw this year, the foreign funds return to the Philippines, then it's really going to buoy your stock market. And so far, year to date, net foreign buy is already more than 30 billion pesos. Next, the Philippine peso reversed its weakening trend. The reason this matters a lot to investors is maybe for us, it's not that big a deal, but for those who are listening who are importers, you probably watch the currencies, the Philippine pesos move versus the dollar on a daily basis. For foreign funds, it is the same. Um, their financial statements are denominated in dollars, meaning to say, if they buy, say, Jollibee at 300 pesos, and 1 year from now, it's still at 300 pesos, for you and me, we make nothing. But for them, if the peso goes from 50 to 54, even if the stock they buy is at the same price, they lose 8%. So if there is a view that the currency will continue to weaken, it's like telling these foreign funds that over time, you're going to keep losing money. So they sold. However, what we saw now is the peso strengthening significantly from the lows last year, and that attracted a lot of foreign funds back into our market. Now, internationally, you had Fed Chairman Jerome Powell from wanting to raise interest 3 times in 2019, now to no longer raising interest rates. A lot of central banks have also become very dovish and kept interest rate hikes on hold. Some are even reintroducing stimulus. There's a whole entire presentation for this stuff, but because of time constraints and since all of you might want to enjoy your vacation, we're not going to discuss that too much. But the basic point there is that markets generally like interest rates lower than higher. So when Fed Chairman Powell dialed down his interest rate hike forecast for 2019, stock market investors took this as a positive because he was acting that way in order to prevent a global growth slowdown. So if he prevents a slowdown, that would be good for economic growth, good for corporate earnings, and therefore good for stock prices. Now, the big elephant in the room has been the US-China trade war. So there's now less noise on that, and you also already have more positive news flow on that front. There's no deal yet, but there is news that it's 90% complete. Talks are now have been constructive, and both sides are narrowing their differences. So this is a big change in tone versus what you had last year. So I just want to show you what it looks like when I said foreign selling reversed into buying. So this is what you see this year. If the number is in green, it means the foreign funds are buying more than they're selling. So for example, if you look at say January 28, they bought 2.2 billion pesos more of Philippine stocks than they sold. If it's red, it means they're selling. So typically, you want to keep seeing green, which means the foreign funds want to buy the Philippines. But last year, this is what it looked like. So it was all red. In fact, last year, you had the record. You had 44 straight days of net foreign selling, the longest streak on record, surpassing even the 2008 US financial crisis, 1997 Asian financial crisis. It's the longest streak of uninterrupted foreign selling in Philippine history, which is why our stock market went from a high of 9,078 all the way down to 6,790. But since then, some of these foreign funds that sold are coming back. I want to show you the peso. And you'll see last year at one point, for the chartists or listening, 54 was a crucial support level. When that was broken, it was already pointing towards a move to 56, which would really have been difficult for the Philippine economy. But since hitting a low of 54.48 last year, the pesos appreciated more than 5% against the US dollar. So you see now it's firmly below the 52 level, which is a crucial resistance level. So if we can stay below 52, it looks like we can range between 51 and 52, which will make the Philippine stock market more attractive to foreign investors, which conversely feeds your foreign flows, which makes your stock prices go up, which is why I've been saying now is the time to buy stocks. So what's the fair value for the PSCI in 2019? And the way we calculate this number is we have a research team. They come up with target prices for the 60 index stock. So those are different metrics: PE, price to book, discount to NAV, and once they come up with the target price, it's multiplied by the weight of each stock in the index, the 30 components, and they come up with the target. And our fair value is 8,560. That assumes 2018 earnings growth 6.2%, and for 2019, 10% earnings growth. At that level, if you just use a PE multiple, it translates to roughly 18.5 times PE, which is closer to the cheaper end of the range, because in the past 9 years or so, we've been trading at 17 to 22 times PE. Now, one thing I want to tell our viewers is that last year, think about it, the PSEI was at 8,000 at one point. This year, we're already close to 8,000 again. But the difference is, this year, you have 10% earnings growth on top of what you had last year. In other words, if the PE of the Philippine stock market doesn't move, it just stays where it is, the upside of an investor this year is at least 10%, which is the earnings growth. So if the PE goes higher than where it was last year, then that's your additional upside. So we think that at this level, because you're buying at last year's level, but with this year's earnings, you're entering the market at a very attractive level. But I understand that it's not in everyone's character to buy stocks. Some say it's too hard to understand, too complicated. Some people have lost money before because either they say they're not an expert, or they treated the stock market like a casino. Or some people who are too busy running businesses say, I don't have the time to buy stocks, so I'll just stick to what I know. Now, if you want to profit from the bull market in Philippine stocks, but have neither the time nor inclination to buy stocks directly, then you can just buy an equity mutual fund. So for those who are not familiar with what a mutual fund is, it's basically not like pyramiding. And what happens is we pull together money from different investors. That money is then invested in different stocks depending on the mandate of the mutual fund. We'll go to that later. And that investor would own shares in the fund, and the value of the shares would change depending on the movements of the stocks the fund bought for its investors. And this mutual fund is managed by a professional fund manager. In Philequity's case, it's Wilson C. He eats, breathes, and dreams stock, so that's really all he does, which is great because he's focused on it, while you guys can go on vacation. He doesn't really go on vacation. So he runs the Philequity group of funds. We have 6 funds. I understand that last week we talked, ATR talked about fixed income. So for this week, we're going to focus on the equity funds. So we have 4 here. And as was mentioned earlier, just don't get intimidated. They say that you'll only make money in the stock market if you have money already. That is not true, because now we have lowered the minimum to 1,000 pesos and minimum additional investment to 500 pesos. So, anyone can participate in the stock market. Anyone can make money from investing in the stock market. I wish I started earlier, so the young ones watching, you're very lucky. If you're still in school, even better. Start investing your savings already instead of buying the next phone or traveling. So there are different types of funds that we're offering. One is the Philequity PSE Index Fund. This is basically a tracker fund. We say it's a tracker fund. What it does is it just moves exactly the same as the Philippine stock market. So it's plain vanilla. So of all the funds we have here, this is probably, well, not really the most boring, but it's the one that's, let's say most basic level for entering the Philippine stock market. So it does approximately the same return, although we outperformed a little bit. But roughly, you're going to make 9+% CAGR over the past 18 years, 19 years or so. The next is another tracker fund. It's called the Philequity MSCI Philippines Index Fund. This one tracks the MSCI Philippine Index instead of the Philippine Stock Exchange Index. So there's this benchmark provider abroad, probably the biggest, MSCI. He makes benchmarks for different countries, and the foreign funds follow these benchmarks and they invest in those. For example, the PSEI has 30 stocks. The MSCI Philippines has only 23. So, and we see it in the flows, the foreign funds really stick to these 23 names. So we made a fund that clones this MSCI Philippines index. So there you have it. It's just newly launched. We started this year. So it's already in the green for the year, and it's beating its benchmark actually by a little bit. So if you want a tracker, we have two different types of trackers. The advantage of the MSCI Philippines Index Fund is if you think foreign funds are going to go back to the Philippines in a big way, this fund is likely going to outperform. But conversely, if the foreign funds start selling, naturally the stocks in this fund, which are what the foreign funds track, will be sold down more, and it may outperform the plain, it may underperform the plain vanilla PSEI tracker. Now we also have a dividend yield fund. So what this fund does is it invests primarily in stocks that pay dividends. The higher, the better. So you can think of this as a more conservatively handled fund in that you buy more defensive stocks because you're after yield more than capital gains. So when the market is going down because of the dividend yield, this fund tends to outperform. But when the market goes up a lot, it tends to underperform. You'll see the Philequity dividend yield fund in yellow, the PSEI in red, and you'll see during downturns, that's when the dividend yield fund does really well. And then when the market goes up a lot, tumahabol na yung benchmark because this fund underperforms in the up move. So if you want to go defensive among our mutual funds, this is the one you want to buy. Finally, we have our flagship fund, the Philequity Fund. This was launched in 1994, so it's been around for roughly 25 years already. And this fund has gotten a lot of awards, but one particular award I want to focus on is the Best Managed Equity Fund Award, which the CFA Society gave us. Typically, other funds get the award by being the best performing fund, meaning highest return for the year. Now, what the CFA Society did is it awarded the fund based on highest risk-adjusted return. So not just the upside, but based on how much risk you're taking, how much money are the investors going to lose, or did they lose when the market actually went down? So they use something called the Sortino ratio, which measures your return, excess return versus your downside risk. And for 2016-2017, Philequity bagged the top award for that, and we're very proud of that, on top of the dozens and dozens of awards we've gotten. But you know, awards are one thing. The actual return on your money is something else entirely. So to show you here in yellow is the return of the Philequity Fund going back to 1994 versus the return of the PSEI going back to the same to 1994 as well. You'll see over the time period, the PSEI made 4.1% a year compounded, but the Philequity Fund made a whopping 15.6%. So a very large outperformance. That's 11.53% outperformance every year for the past 25 years, and that added up. So which is why our NAV is very close to its highs. So we don't outperform every year, but if you add it up, it's more than 10% outperformance since the inception of the Philequity Fund. So if you put that in, you know, monetary terms, if 100,000 invested in 1994, assuming you didn't add, you didn't sell, you just put in 100K, did nothing with it, now it's already worth 3.77 million. So that's over 25 years. Now, just to show you Philequity's performance on an annual basis, you'll see a big chunk of our performance really comes in the down years. In the second column, that's the percent return of the Philequity Fund per year. In the third column, it's the index. You'll see, for example, in the Asian financial crisis, where the market lost nearly half its value, we only lost 5%. And the year after, the fund gained 30%, even though the market was up only 5%. If you look at the year 2000 to 2002, when we had the political crisis, Philequity is roughly flat over those 3 years. But the market lost easily more than 50%, close to 60% of its total value from 2000 to 2002. But at Philequity, we don't get everything, right? Sometimes we lose money also. In 2008, we lost about more than 40%. But Mr. C, our fund manager, made sure our investors would get their money back as quickly as possible. In 2009, the fund gained 65%. And I was just in my first job then, and I remember that Philequity was the first mutual fund to go up to go back to break even after the US financial crash. Back then, I was invested in a different mutual fund, and I realized it was a mistake. I should have invested in Philequity. So don't make the mistake I did then, especially the young ones here. So to end this presentation, if you're too busy with your business or taking vacation, but you want to participate in the gains that you saw the Philippine stock market had in the growth of our economy, which translates to higher stock prices, but have neither the time nor inclination to pick stocks, watch the market every day, worry about whether your portfolio is up or down, then let Philequity worry about your money for you. So thank you very much. Have a good afternoon and enjoy your Holy Week.
Thank you for that very insightful discussion, Miguel. So for everyone tuning in, what are your takeaways? Send them in the chat box in the side panel provided so everyone can see and learn from each other. Now, before we proceed with our Q&A, we would like to remind everyone who is not yet a member to join our growing Facebook community. You can simply type in www.facebook.com/groups/FirstMetroSec or search FirstMetroSec official community on Facebook. Also, don't forget to like and follow the official Facebook page of PEMI to get their latest updates at www.facebook.com/Philequity or visit their website at www.philequity.net for more information. Now on to our Q&A. Let's start with some questions which were sent via email. If you have any questions for Miguel, just type in your questions via the side panel provided if you're on your computers, or swipe left if you're viewing this webinar through the app on your mobile phones. First question for Miguel. Can you briefly explain why an investor should choose PEMI's flagship fund versus dividend yield versus PH index?
Okay, well, the one way to do it is you could own all three, but if it were me personally, I would just, if I had to own only one, it would be the flagship. The reason is that the index fund will just do exactly what the index is doing. And Mr. C is a very, very good fund manager, arguably the best in the country, and he will add outperformance over what the index actual performance is. As you saw in the slides earlier, the Philequity fund, flagship fund, outperformed the index very significantly. So versus the index fund over the long term, the Philequity fund will outperform. Now, there will be years where the index fund does better, especially in very, very, very strong up years. You're going to see the index fund do better. But over the long term, I think the Philequity fund is better. But for the dividend yield fund, it does better when the market is going down. But when the market is going up, it also underperforms. And you can check it statistically, the market goes up more often than it goes down. So if I had to pick one, I'd pick the flagship. But if I were you, I would diversify my mutual fund holdings across the different Philequity funds because they all serve different functions, they have different mandates.
Thank you for that, Miguel. Second question sent to by email. What is your year-end PSCI target?
Yeah, as I mentioned earlier, it's 8,560 for end 2019. That's our fair value for the PSCI.
One question sent through the chat box. May I know the asset classes in Philequity fund?
Okay, the Philequity funds that I showed you earlier, these are all pure equity funds, although we have a couple of fixed income funds. So, but the ones I discussed earlier are 100% equity.
A question sent through email. If we're worried about the market now, where should we put our money?
Well, if you're worried about the market now, what you can do is maybe buy slower, or my suggestion is you do peso cost averaging. In other words, you set a fixed amount of pesos that you're willing to invest every month. And if the market falls, then you'll end up buying more Philequity fund shares. Um, so you'll be able to take advantage of the dip. Or if you're, feel very, very, very concerned that the market is going to fall, you can maybe reduce your buying until, it gets clearer to you that, okay, maybe the market's on its way up or the risks are gone. But if I were you, should always have a chunk of your portfolio in stocks, because over the long term, even if the market underperforms for 1, 2, 3 years, you see over 10, 15, 20 years, there's no asset class that can give you the return that equities do.
A question from Mr. Ronald Ardell. Should you sell some of your shares when the PSEI is at its peak, or should we just continue on adding to our investments?
Well, I'll answer that question two ways. One is calling the peak for the market requires luck, hindsight, or maybe a crystal ball. So it's very hard to determine when the peak of the market is. So I think the better way to do it, and for those here who believe in technical analysis, you'll notice that whenever a stock makes a new high, it tends to make more new highs after. So in other words, new high means higher. So if the Philequity fund makes new highs, that may actually be a signal to add more instead of actually selling. It means that something very good is happening to the stock market.
Hi, Miguel. Any suggestions for a book to read regarding technical analysis?
Okay, if you guys are super, super technical analysis people, I will suggest only one book. And Mr. C told me that this is the only technical analysis book I should read. So this is probably one of the very important tips you're going to get today. He said, read only Technical Analysis of Stock Trends by Edwards and McGee and read nothing else.
A question from Hy-Vee and Daya. Are these funds exclusive only to FirstMetroSec clients, or are there any available on other brokers? Yes, they are available. I can answer it for you, Ms. Hy-Vee. They are available for FirstMetroSec clients. A question from Mr. Mark Chu. Do you have any funds that invest in US or foreign stocks?
We don't have yet, but we'll soon have one. We recently incorporated the Philequity Global Fund. That's not up and running yet, but it's in progress. We're going to have that ready at some point in time, but we've already started the process.
We can accommodate 3 more questions from Ms. May Rams. What is a good asset allocation do you recommend to achieve at least 8 to 10% growth for the next 3 years?
Okay, what's the name of the person who asked this? Okay, hi May. That is a very tricky question because hypothetically, May, if I find a 10-year bond that gives you 8% yield, then I'll just go 100% bonds and 0 stocks, right? But there's some research says it's 60-40. 60% stocks, 40% bonds. You'll even find formulas out there depending on your age. My opinion on the matter is don't follow these formulas out there. You just think to yourself, how many percent of my portfolio can I put in stocks and yet still sleep well at night. Once you've determined that amount, and it may change in different time periods, depending on how much money you make, then you put that percentage in stocks, then you can put the rest in fixed income or other assets you're comfortable with. Personally, majority of my money is in equities, and in very strong markets, 100% of my money is in equities. But there are times like when you have bond yields going very high. Of course, you want to put part of your portfolio in fixed income. So it really depends.
Thank you for that, Miguel. We have another question from Ray Carl Masado. Hi, Miguel. I already have UITF from various local banks. However, after 5 years invested, my current return is still about negative 20%. In same period, what's the performance of Philequity fund? Also, what's the difference between UITF and mutual funds?
Okay, I'm gonna get the 5-year return for you in a bit, but the difference between the UITFs and mutual funds is number one, the issuer. UITFs are issued by banks, mutual funds by non-bank institutions like the insurance companies. Second is UITFs can be 100% invested, whereas mutual funds can only be 95% invested. But I guess that rule is going to change soon. As far as return is concerned, the compound annual growth rate of the Philequity fund over 5 years is 3.2%. So in other words, you should be making about over the past 5 years about 17% roughly, positive 17, which would be a 37% outperformance over the fund which you invested in, which is why I was saying don't make the mistake I made when I was younger of not investing in the Philequity fund. It's arguably the best mutual fund out there. You can look at the long-term return of other funds. Maybe over 1, 2, 3 years, maybe there's a fund that can beat Philequity, but over 10 years or more, Philequity would have the best return.
Last question for today from Mr. Jason Mape. Is Philequity Fund the best mutual fund out there?
Yes.
Right, quick and simple. Thank you, Mr. Miguel. Thank you everyone for participating in our Q&A. And now for everyone's most awaited part, our giveaway. This afternoon, we are giving away FundSmart bundles and the grand prize of 3,000 peso worth FundSmart investment certificate to be invested in any PEMI fund. These bundles are exclusive FirstMetroSec travel blankets and an opportunity of a lifetime book by the Warren Buffett of the Philippines, Mr. Wilson C. Here's how it goes. Take a screenshot of the next screen, go over to your Facebook wall and post it along with a caption about your favorite part of this afternoon's webinar. We will be choosing 3 lucky winners for the FundSmart bundles, and the one with the best caption will win the investment credits. Please be sure to make it public and tag us at First Metro Securities. It's that easy. Our winners will be contacted personally via Facebook or via email. Are you guys ready? So here is the screen. And for everyone looking into winning more exclusive FundSmart and FirstMetroSec goodies, we currently have our FundSmart Summer promo. Invest in any FundSmart fund, PEMI included of course, for as low as 5,000 pesos to get 1 raffle entry. The more raffle entries you have, the more chances of winning. Flashed on screen are PEMI's eligible funds available for the promo. This runs from April 1 to June 30. More details are available on our website. And that is a wrap. Thank you everyone for tuning in. We hope to catch you on Monday, April 22 for our Besties webinar with Marco Tarog. And then again on Wednesday, April 24 for another FundSmart webinar series with Edwin Valeroso of First Metro Asset Management. You can find more details posted on our calendar at www.firstmetrosec.com.ph under Seminars, Promos, Publication, and then Calendar of Seminars. And if you're looking to stay up to date with our latest events, seminars, and everything in between, Like, follow, and subscribe to our social media channels flashed on screen. This has been your host, Cara, along with our speaker, Miguel Agarao of Philequity Management. And as always, it's hashtag your future first. Bye.
Okay. Enjoy the Holy Week, people, and find time to relax.